Are you struggling with the CPA exam because your course failed to fit your learning style? I'm Darius Clark of I-75 CPA Review, where the right teacher makes all the difference. Hey, it's Darius. Did you fail the CPA bar exam? If you failed bar, you probably need a little help on the top 5 CPA exam bar topics. And in this video, we're going to go through a question together on all 5 of these bar topics, starting with ratios. Maybe you saw a question like this on your exam. The current ratio of a company starts out at 2 to 1. The company then borrows $40,000 in cash for 9 months. What is the impact on the current ratio? Did it increase, decrease, stay the same, or there's not enough information to determine the change? So in this question, they tell you the ratio starts out at 2 to 1. What does that mean? Well, for the current ratio, that means $2 of current assets for every $1 of current liabilities. And then the company borrows $40,000 in cash. That means cash goes up. That's current assets up. But then current liabilities are up also. So numerator up, denominator up by the same amount. So maybe you're thinking, C, the ratio stays the same. Because current assets would go up by $40,000. Current liabilities would go up by $40,000. Both numerator and denominator would go up by the same amount. Why would the ratio change? But the ratio will decrease. And it has nothing to do with accounting. It's just a math trick. But the CPA exam loves it. So here's how you win. So the current ratio, or any ratio, if it starts out above 1 to 1, and you're going to add the same amount to both sides, well, 2 to 1 here, the numerator is the 2. The denominator is 1. $2 in current assets for every $1 in current liabilities. So your current ratio is 2 to 1. Instead of adding $40,000 to both sides, let's add just 1 to both sides, the number 1. So if we add 1 to the numerator, 2 plus 1 is 3. If we add 1 to the denominator, 1 plus 1 is 2. Do you see how by adding 1 to both, we've gone from 2 to 1 to 3 to 2? A 2 to 1 ratio is higher than a 3 to 2 ratio because a 3 to 2 ratio is 1.5 to 1. So the answer is B, the ratio decreases. If any ratio starts above 1 to 1 and then both the numerator and denominator increase by the same amount, the ratio will decrease. In this case, the ratio decreased from 2 to 1 to 1.5 to 1. Why? Because we added 1 to both the numerator and denominator. And instead of 2 to 1, we wound up with 3 to 2. And 2 to 1 is higher than 3 to 2 because 3 to 2 is 1.5 to 1. 2 to 1 is higher than that. So this question asked, the current ratio starts out at 2 to 1. The company then borrowed $40,000 in cash for 9 months. What's the impact on the current ratio? And the answer is the ratio decreased. And all we needed to do was to add 1 to both the numerator and denominator. Because numerator and denominator both increased by $40,000 by the same amount. So we added 1 to both sides. And you might be thinking, instead of both sides going up by the same amount, what if both sides go down by the same amount? So that leads us to this ratio question. If the current ratio is 3 to 2, that means $3 of current assets for every $2 of current liabilities, right? 1.5 to 1. And then accounts payable of $22,000 is paid off with a similar amount of cash. Which of the following is correct? So the difference here is both sides of the ratio are going down by $22,000. Accounts payable is going down. We're using cash to pay it off. So accounts payable is a current liability is down, and cash is down. And both current assets and current liabilities are going down by the same amount. And the ratio is starting at 3 to 2. So let's use, instead of 22,000, let's use 1 again. Let's take away 1 from both numerator and denominator. We go from 3 to 2, which is 1.5 to 1, to 2 to 1. And 2 to 1 is higher than 3 to 2. So this ratio has just increased. Letter C is correct. The ratio started above 1 to 1 again, this time at 3 to 2, but this time the numerator and denominator have both decreased by the same amount. And we saw that the ratio would then increase. Why? Because the ratio started at 3 to 2, $3 of current asset for every $2 of current liability, or 1.5 to 1. Accounts payable is paid off, so subtract the same amount from both sides because we used cash to pay off accounts payable. So we ended up with a 2-to-1 ratio. From 3 to 2, we go to 2 to 1, and 2 to 1 is an increase over 1.5 to 1. So this ratio question wanted to know what happens if the current ratio is 3 to 2 and accounts payable of $22,000 is paid off with a similar amount of cash. Which of the following is correct? The ratio would increase, and that would be any ratio. Doesn't have to be the current ratio, could be the quick ratio, could be any ratio. If you subtract the same amount from both sides and you started above 1 to 1, that ratio is going to increase. All right, that's ratios. Another top CPA exam bar topic is cost accounting. Maybe you saw a question like this on your CPA bar and you didn't know how to handle it. Drexler Corp is a manufacturing company with both fixed and variable costs. Which of the following costs would decrease if production levels were increased within the relevant range? This is a question on what they call cost behaviors. And you need to know that fixed costs are only fixed in total. Fixed costs on a per unit basis. Are fixed costs fixed on a per unit basis? No. Fixed costs are only fixed in total. Fixed costs vary with production on a per unit basis. You produce more units, your fixed cost per unit will go down. So which of the following costs would decrease if production levels were to increase within the relevant range? And the answer is fixed cost per unit. Letter D is correct. Fixed costs are constant in total, but fixed costs decrease per unit as production levels increase. For example, if rent is fixed at $1,000 per month and 100 units are produced this month, well then rent per unit is $10 per unit. But what if 200 units are produced next month? Well then rent per unit drops at a cost of $5 per unit. It went from $10 per unit when we produced 100 units to a cost of only $5 per unit when we produced twice as many units, 200. So you have to know on the exam that fixed costs are only fixed in total. They vary with production on a per unit basis. The more you produce, the lower your fixed cost per unit. What if one month we only produced 1 unit all month? Well then rent per unit would be $1,000 per unit. What if we produce 2 units? Then rent per unit would be $500 per unit. The more we produce, the lower the fixed cost per unit. So this question asks which of the following costs would decrease if production levels were increased within the relevant range? And we said the answer is D, fixed cost per unit. Why is C wrong? Total fixed costs, they're constant in total. The call of the question relates to per unit fixed costs. Fixed costs per unit decrease as production levels increase. You can produce as many units as you want. The total fixed cost, the total rent for the month, will still be $1,000. And B is wrong. Variable costs per unit remain unchanged over the relevant range, but variable costs will increase in total as unit volume increases. Let's use direct materials as an example of variable cost per unit. And let's say we produce tables, and each table requires 4 legs of direct material. If each leg costs $20, then it's going to cost $80 of direct material to build each table. Variable cost per unit, no matter how many tables we make, is still going to be $80 for legs. $20 per leg times 4 legs. So variable cost per unit does not change. A is wrong. Total variable cost increases as total unit volume increases in the relevant range. So the more tables we produce, the more legs we actually had to pay for. So as total unit volume increases, total variable cost increases, but variable cost per unit will still be $20 a leg, no matter how many tables we make, within the relevant range. So which of the following costs would decrease if production levels were increased within the relevant range? Fixed costs, not total fixed cost, but fixed cost per unit decreases as we produce more units. And the exam loves this kind of question. All right, now let's go to variance analysis. Big topic in CPA bar. Maybe you saw a question like this where it says calculate the direct labor rate variance, and they give you this information. Some of it might be relevant, some of it might not be. A rate variance, we're interested in the difference between the actual rate and the standard rate. Looks like they paid $30 for direct labor when the standard was only $27. So that's an unfavorable rate of $3 per hour. So we know the answer is going to be unfavorable, either B or D. Now, in a rate variance, we want to multiply that $3 difference in rates times the actual hours worked or the standard hours. They give us the standard hours, 4,500, but that's not what we want. In a rate variance, we want the difference in rates times the actual hours worked. But hey, wait a minute, Darius, they didn't give us the actual hours worked. No, but they gave us the actual direct labor cost of $120,000, and they told us the actual per hour labor rate was $30, so we know they must have actually worked 4,000 hours. We just divide $120,000 of actual direct labor cost by the $30 actual per hour rate to get the actual hours worked. And we need the actual hours worked, 4,000, to multiply by the difference in the two rates, $3, and that gives us a $12,000 unfavorable direct labor rate variance. Letter B is correct. So here they asked for the direct labor rate variance, and the answer is B, 12,000 unfavorable. We knew it was going to be unfavorable right away when we noticed that they paid $30 per hour for labor when they only expected to pay $27. The trick to this question was they didn't give us the actual hours worked. We had to calculate it. Now let's look at CPA exam bar topic number 4, business combinations. And you might have seen a question like this. Pacific Company issues 200,000 shares of $5 par common stock to acquire Signal Company in an acquisition business combination. The market value of Pacific common stock is $12 a share. Legal and consulting fees incurred in relationship to the purchase, $110,000. What do we do with legal and consulting fees incurred? Are they expensed? Yes, they are. So the $110,000 is going to be an expense at acquisition. Registration and issuance costs for the common stock, $35,000. Are they expensed? No, they're not. They're a direct reduction of additional paid-in capital. And that's what they're asking. What should be recorded in Pacific's additional paid-in capital for this business combination? And the answer is D, $1,365,000 will be the additional paid-in capital. That's because in an acquisition method business combination, registration and issuance costs, they're recorded as a direct reduction to the value of the stock issued, and that's going to reduce additional paid-in capital. Now, direct out-of-pocket costs such as legal and consulting fees, they get expensed. So this business combination will be recorded on the parent's separate books as follows. They're going to debit legal and consulting expense for that $110,000, and then they're going to debit investment in Signal Corp for the market price of Pacific Company's stock, which is what they issued in order to acquire Signal Company stock. The market price is $12 times 200,000 shares. That's your $2 million for debit to the investment account. They're going to credit cash for $145,000. Why? Because the legal and consulting fees were $110,000 and the registration and issuance costs, that was $35,000 more. So credit cash for $145,000, but notice we can only debit legal and consulting for the $110,000. Where's the extra $35,000? It's going to be a reduction in the APIC. But before we look at APIC, let's look at the common stock. Common stock's the 200,000 shares issued times the $5 par. We always credit common stock for par. That's $1 million credit to common stock. And then you're going to have debits higher than credits by $1,365,000. So we could plug APIC, or we can determine that 200,000 shares times the market price of 12 minus the $5 par minus the $35,000 that we said we're going to have to reduce APIC for registration and issuance costs. That gets us to $1,365,000. So this question wanted to know what should be recorded in Pacific's additional paid-in capital account for this business combination, and the answer is D, $1,365,000. So in a question like this, you would have to know that legal and consulting fees paid in a business combination would be expensed, but not registration and issuance costs. They would be a direct reduction of APIC. And now, topic 5, government-wide financial statement reporting. And maybe you saw a question like this. Under government-wide financial statement reporting, which of the following is part of the, quote, basic financial statements using the general purpose financial statement approach? A bit wordy. So we're looking for What's part of the basic financial statements if we're using the general purpose financial statement approach to government-wide reporting? How about MD&A and RSI? No, they're not part of the quote basic financial statements, and you would have to know that. What about the notes to the financial statements? Yes. Reconciliation? Yes. You need to know what's included in the quote basic financial statements using the general purpose financial statement approach, and it would be the notes to the financial statements, the reconciliation, the financial statements themselves, but not MD&A and RSI. So the answer is D, 3 and 4. 3 is correct. The notes, they're considered to be part of the quote basic financial statements under the general purpose financial statement approach, and 4 is correct. The general purpose financial statement approach requires a reconciliation from fund financial statements under modified accrual to the government-wide statements prepared full accrual. The reconciliation may appear on the face of the financial statements, or that reconciliation might appear in the notes. Either way, that reconciliation is part of the quote basic financial statements. Note that MD&A and RSI, they're also required. They're required reporting under general purpose financial statement reporting, but MD&A and RSI are not considered part of the quote basic financial statements. And this question specifically wanted to know which of the following is part of the quote basic financial statements using general purpose financial statement approach, and the answer would be notes and reconciliation. Letter D is correct. Now, if this question was worded just a little bit differently, then all 4 of these could be correct. The answer might have been A instead of D. Let's watch. This time it says, in government-wide financial statement reporting, which of the following is required as part of general purpose financial statement reporting? And the same 4 are listed. But this time it's not asking about the quote basic financial statements. It just says, which of the following is required as part of general purpose financial statement reporting? And they all are required. The MD&A, the RSI, the notes, and the reconciliation. So worded this way, the answer is A, all 4. MD&A provides an overview and analysis of the financial activities of the government and is required as part of general purpose financial statement reporting for government-wide financial statements. It's just not part of the, quote, basic financial statements, but it is required, the MD&A. RSI includes additional information that GASB considers necessary for financial reporting. RSI goes beyond the basic financial statements, but it is essential and it's required. Notes to the financial statements and reconciliation, we know they're part of general purpose financial statement reporting because the notes and the reconciliation, they're even part of the basic financial statements. This question just asked, though, which of the following is required as part of general purpose financial statement reporting? And it would be MD&A, RSI, the notes, the reconciliation. What else would be required as part of general purpose financial statement reporting? The financial statements themselves, the fund-based financial statements and the government-wide financial statements, like the government-wide statement of net position and the government-wide statement of activities. So if you failed the CPA bar exam, make sure you get to know these 5 topics just a little better. And if you're struggling with a different topic on the CPA bar exam, leave it for me in the comments section. And remember to like and subscribe because it really helps the channel out a lot. And if you're serious about passing the CPA bar exam, go to i75cpareview.com and get yourself on the right road. I'll leave a link in the description, but get yourself on I-75 with me, Darius Clark, because the right teacher makes all the difference. I-75 bar, you won't need any other materials to pass the CPA exam. Choose either the I-75 bar monthly subscription, that's the one on the left side, or if your exam is within a week or 2, then choose the I-75 bar cram course. The bar cram is a one-time payment for 15 days. The monthly subscription is $129 a month, but you can cancel anytime. You can even reach out to me and I'll cancel for you personally. I'll leave a link in the description. Get yourself on I-75 today and be home soon.